Good afternoon, ladies and gentlemen, and welcome to the SAIEE KZN Centre webinar on financial modelling of renewable energy projects. Before we start, a few webinar considerations. Attendees are reminded to ensure the volume is turned up on their device. Ensure you have a stable internet connection. This will ensure the streaming and audio will run smoothly. Attendees can ask questions via the questions panel located within the GoToWebinar control panel. By default, the control panel is located on the right-hand side of your screen. The chat function is reserved for webinar organizers and panelists to communicate with attendees. Attendees will not be able to chat with each other, however, are encouraged to ask questions. A recording of this webinar will be made available on the SAIEE YouTube channel, SAIEE TV, under the KZN Centre playlist. This channel is updated regularly, so ensure you check out the chat box, find the registration link and register. It's free. A certificate of attendance will be issued a few weeks after this webinar once we've received the CPD validation from EXA. I'd like to introduce you now to our host this afternoon, is Mr. Richard Olschlager, who is Chairman of the SAIEE Kwa-Zulu Natal Centre, and he's also the Technical Director for Energy Resources and Manufacturing Projects within Zutari. He is considered a multidisciplinary technical generalist on many aspects of power transmission, generation, and distribution, and has the practical design and project management experience in both substation and line projects. He spent 10 years working for Eskom as a protection and technology specialist, primarily in protection, automation, and DC standby systems, where he represented Eskom on several national working groups. Over to you, Richard.
Thank you, Minx, and welcome everybody. I hope those that are visiting or in Durban are traveling safely. There's been quite a lot of drama in the last hour or so down here in KZN. So I'm trusting and praying that you're all safe and not trying to navigate, drive, and also listen to the webinar. That being said, I'd like to just introduce Mr. Tate. Minx, can you just flip the slide there, please? So we have had a relationship on several projects, and I specifically targeted Andy as to come and present to the SAIEE, because I do believe that what he is going to share and the experiences that we've had with Cresco are going to be quite illuminating and add a lot of value to those of us that are involved in projects and project development. Basically, Andy is heading up the Cresco financial modeling team. As I said, I've had experience with him on one or two projects in Zutari. My company have had dealt with Cresco extensively, and there's significant value in terms of coming to clients with a business case and a bankable study, and that's where Cresco has added quite a lot of value. And they've got quite a broad-based experience in various different fields. So we've used them on tri-generation facilities and PV facilities, etc. So it's a lot of the strength is in the models that they develop, which are these financial models. But I'm not an expert on this. I tend to be a little bit more on the technical side. Mr. Tate, Andy, thank you so much for coming and presenting today. And it's really a pleasure to have you as part of this, well, coming to present to us today. Thank you so much.
Thanks, Richard. Thanks for the intro. Just want to make sure you can see my screen is coming through. Can you see the presentation?
And just put in presentation mode, please.
Yep.
Perfect. Thank you.
Okay, great. Good afternoon, everybody. Just to cover off what we're going to talk about. So, I mean, first of all, welcome to financial modeling. Hopefully it'll be an interesting session, a bit illuminating, give you some idea of what the financial analysts are looking for and doing and trying to achieve. So as part of this, I mean, really what we want to cover is the types of functionality and the requirements of the different financial models that we use when helping to develop sort of energy strategies or energy projects. So we're going to cover off a few items. We'll just give you a quick overview of Cresco, give you some idea about our client base and where we fit into these sorts of projects. Then we'll cover effectively in a fair bit of detail a typical sort of bankable feasibility study type financial model, and work through what that does, how it calculates the results, and what's needed in order to be able to get that model into shape. That then is really, I suppose, the sort of nub of most financial models. We then work through some of the other models that we quite often are asked to provide. The first one being an operational monitoring model. So once your solar plant or your wind farm or whatever has achieved financial close, there's a completely different type of financial modeling support that's required on an ongoing basis. Then we look at how we actually assist particularly private power consumers to develop and implement an energy strategy, which uses different financial models depending on what we're trying to achieve at that point in the development of the energy strategy. And then we look at some of the specific ones. We're really just looking at how the functionality is different and what these things can do in order to provide the answers that the clients require. So we're looking at sort of a generator and off-taker on site. Think of a sort of solar PV type project at a mine or something. We're looking then, how do we incorporate wheeling using the ESCOM grid into these models, cogeneration, battery energy storage. Then possibly a bit more unique is the sort of bid scoring models. So we've quite often been involved with assisting large power consumers to procure on an RFP basis from IPPs, and how what's the sort of functionality and things that go into that. And then at an even bigger sort of level, the energy strategy financial models. How do you put together a complex energy strategy and understand the financial implications of that? And then on a slightly different note, but still covering renewable energy, is a broader sense of decarbonisation financial models. It was like, how do you actually put together various aspects of a bigger decarbonisation strategy and understand the financial implication? So I suppose let's start off with it then. In terms of Cresco, so in the energy sphere, typical type of clients that we deal with: independent power producers, so assisting them with financial modelling, financial advisory, raising finance is a big part of what we do. Then looking at sort of large single-site energy users, potentially multi-site energy users, in terms of what they require, looking at transactional support, as I said before, in terms of actually procuring and developing their strategies. Then we've also looked at the smaller distributed energy users, think sort of cell phone companies, that sort of thing, where we've got a large number of small loads distributed across a wide geographical base. We assist investors and financiers, particularly with sort of strategies to enter markets, etc. We also look specifically at sort of climate finance and sort of credit enhancement in order to make projects financially perform better. And sometimes we also assist OEMs or technology providers with their market entrance strategies as they try to break into new jurisdictions. I think one of the things that, just to cover off, is we see there's a huge demand for renewable energy projects. I'm sure that's no surprise. In terms of this, I think that the ultimate result is that doing nothing isn't an option for a lot of our clients. They have to achieve a high level of carbon neutrality, particularly in terms of trying to ensure a continued market for their products. And hence, developing such strategies is quite an important part of their current activities. And yeah, I think it's still in some ways quite new, and people are learning as they go. And particularly the way that South Africa is approaching some of these things is not necessarily exactly the way that things have been done in Europe. If you look at, for instance, the terms of power purchase agreements, things like that. In terms of where we fit in, so we tend to try to get into projects as early as possible and start guiding strategies from an early stage, often with a light touch type of approach. And this is just an example, but this is, for instance, you develop an energy strategy, then you look at the commercial terms of an RFP and a power purchase agreement, managing the bidding process, adjudicating the bidding process, selecting preferred bidders, and then taking it through to power purchase agreement signing and supporting the client throughout the whole process. And these activities all need different support for the clients. So moving on then to the actual financial models, I'm sure I don't want to hear too much about Cresco. Looking first at the typical financial model and how does that fit in really. So on the left, you'll see that little diagram. These projects typically go through a development process, starting at a sort of concept study level, move through to a PFS, and then hopefully through to a bankable feasibility study. Now, the concept study, we strongly believe that it's worth doing a quick and dirty financial model, not too quick and not too dirty, but effectively something pretty straightforward that you can identify the key drivers. Does it conceptually provide adequate returns? And very often what that model is used for is understanding what you might need to do, particularly if you're in another jurisdiction, potentially needing to have some level of government approvals. It might give you a sense of what you need to ask for and to start opening up the conversation. The pre-feasibility study is typically sort of option analysis, which is the best technical option. Again, financial modeling is really sort of coming into its own here. Much more complex and accurate model would be used, even if the assumptions might still have a fairly significant margin of error. But that allows us to do quite good comparisons between either technical options or financial or commercial options. And then finally, the bankable feasibility study model, typically to about a 10% margin of error. This is sufficient for raising funding on a non-recourse debt basis. So it's a highly detailed model and effectively drives to the final investment decision. And one of the things that we always try to reinforce is it's quite easy to do an expensive, detailed bankable feasibility study on the wrong project. So if you don't do enough work at the pre-feas level, which is, which is a relatively sort of cheap and quick stage of the work, it's very easy to end up effectively studying the wrong project. And that's something that we do try to assist our clients to avoid as a problem. Then, in terms of objectives of the BFS or financial close model, and think this is very much a sort of REIPPPP bid type financial model. Again, its primary purpose is to be used to raise funds from both equity providers and debt providers. So it's the key decision-making tool in the end. And the key thing is to model the cash flows in sufficient detail. So we model both the project cash flows and the investor's cash flows, as these are quite different things in terms of the way the model is used. And typically with a wind or a solar project, you solve for a tariff. Looking at equity returns is typically on a nominal equity IRR basis in rand terms for your typical REIPPPP bidder. Not too complex in terms of that, but in terms of calculating the required cash flow ratios, the models need to get into quite a lot of detail with that. And what really starts to become complex in terms of the financial close modeling is then the debt sculpting approach to try and achieve these ratios without increasing the tariffs. So the financial models these days include quite a lot of macros which enable the modeler to effectively sculpt the debt repayments in order to best achieve the coverage ratios while having the maximum gearing. And the reason for the maximum gearing, or the highest amount of debt possible, is simply because the more debt, the higher the IRR. And because the IRRs are a target, it means that you can reduce the tariff in order, because you've got more debt in, because you're still achieving the IRR. Now, obviously, that's an iterative process, and it does take time to work through that. Then once you've kind of got a base case in place, you start looking at the project's financial performance under different sensitivities. I'm sure you can imagine CapEx, OpEx, generation, etc. And that's pretty standard financial model functionality. These financial models, particularly when it's being funded using non-recourse project financing, which is pretty much the standard in a lot of the larger renewable energy projects. The way the model looks at the world is it looks at it as a special purpose vehicle that owns the project. So it raises finance from both shareholders and from banks. It pays for the construction of the project. It earns its revenues, it pays tax, it pays operating expenses, maintenance costs, and it pays out dividends and pays back the loans. So this is the way that the models typically work. So you're looking at a self-contained company which has as its only asset is this project. Now, obviously, the pre-feas study models have actually quite similar functionality, but typically are just at less detail or with a lower level of detail of input assumptions, because you're really trying to do an options comparison as opposed to necessarily an absolute result. Whereas the concept level models far more limited functionality in terms of tax, etc. So that's really what these models are trying to do. To try and put that into another sort of view, we have the project SPV in the middle there. In the grey arrows are modelling the construction phase cash flows. So the project funders are providing equity and debt. The project is paying money out to EPC contractors and other costs during the construction phase. Then once the project becomes operational, those maroon arrows show that you have an off-taker paying money to the project in terms of its revenues. The project SPV is then paying out sort of operating expenses, tax, and the project funders. And that's really what the project is trying to, or what the model is trying to achieve. Like I said, with all the other functionality to assess what would happen if some of these things work differently in real life. So modeling from first principles is really key in terms of putting together a financial model for this sort of project. And this is maybe something we need to explain or unpack a little bit more, which is for a sort of corporate finance model, maybe it's a merger and acquisition. A lot of the financial modeling is done, you look at the last 5 years of financial statements of the acquisition target, you project those forwards, and you have some view in terms of what's an appropriate price to buy that company. With renewable energy, it's really important to model the project from as close to first principles as possible. Now, particularly what that means is if something does not happen, or if something which happens in a different way, that the project is actually shared, or is actually reflects the cash flows correctly. And the reason for this is really that we need to have sensitivities working correctly. So if you consider, for instance, a fuel model, so maybe it's a biomass project. If there is less fuel or more fuel, that needs to limit potentially the amount of generation, depending on what kind of a stockpile is available. So potentially for that sort of project, you might model the actual fuel stockpile and have some sensitivities around what happens if you're unable to sufficiently top up the stockpile certain years. And everything needs to be built up on that type of basis so that we can understand how different things will impact the model. So energy generation, we put that in as typically as megawatt hours generated, but we need to be able to flex that to see what would be the impact of that. How does that affect the revenues of the project? And bearing in mind that certain projects might have fixed revenues or variable revenues, a fixed capacity charge payable each month versus a charge per megawatt hour generated. We need to be able to look at planned and forced outages and understand what that would mean, particularly if we want to see it, well, it doesn't happen, it's not spread out, it's an event in 1 month of the year. What effect does that have on, for instance, the debt coverage ratios during that period? We look at the sort of fuel consumption we've kind of touched on, energy losses. Typically with wind and solar projects, it's not significant. And again, that energy output, which is maybe more about what is delivered potentially to the off-takers under different circumstances. So if you're bidding into REIPPPP, Eskom buys every megawatt hour that you deliver to the delivery point. If you have a private off-taker and there's wheeling involved, the structure is slightly different. So it's quite important for these things to really work correctly under different circumstances so you can pull the levers in the model and get accurate answers. So in terms of understanding a financial model, the sort of key considerations that we cover is from an equity perspective, how much money do they need to put into this project? With renewable energy projects, that's effectively the investment up to COD. And then what returns are they going to achieve? The main ones used is IRR, NPV, and payback in years. But really IRR is the most used and the one normally used for targeting a tariff. Moving to the right in the red block, in terms of the debt, the lenders focus on the ratios, so the debt service coverage ratio, loan life coverage ratio, and the project life coverage ratio are the most popular ones in non-recourse finance. It's different ratios again to what you might see if using more of a corporate finance approach, and again the quantum of debt funding that they need to provide, particularly under different circumstances. What would be the implications on the quantum of funding if, for instance, there's a delay in the construction phase and that has a knock-on impact. Then to the bottom left, a key thing is model accuracy. So it's a model. All models are wrong, sadly, and particularly that real life doesn't follow the Excel, but some models, well-built models, are very useful to guide the decision-making process. There's a number of golden rules of modeling. In fact, there's a number of sort of international standards to how to go about building financial models. And it's really these days quite important to follow quite closely some of the standards. It has the benefits of firstly making it easy to audit the model, to follow the model, make sure it's calculating things correctly. And secondly, it actually gives some level of simplicity in terms of the way that things are done. That if financial models are built on a similar basis, it's much easier to follow other models that you may need to review. Peer review processes and making sure that somebody else has actually looked through the model and made sure that all the calculations are being treated correctly and that particularly the assumptions are being treated correctly. It's one of the things that we tend to find is that you can have miscommunications over what the assumptions mean in terms of units and what have you. So we work obviously very closely with the technical teams, the likes of Zatari, and it's really important to have a really good understanding of what the assumptions that you're provided for financial modeling purposes, what they really mean, and what's the underlying basis of them. So things like if certain numbers have been converted from dollars to rands, what was the foreign exchange rate used at the time? Or an alternative example would be, you know, if a number for generation is provided, is that the net generation at the delivery point, or is that gross generation before certain losses have been taken into consideration? Is it on a P50 basis, you know, P75, P90, etc.? One of the things that's quite key then to look at is the local tax assumptions. These do vary significantly, has a significant impact on the resulting tariff, even if things like CapEx and OpEx are the same between jurisdictions. Making sure the technical assumptions are up to date is always important. We all know that in a feasibility study, the numbers continually move, and making sure that if some numbers have moved, that it's done as a holistic sort of change, as opposed to sort of incremental bits and pieces here and there. That's also quite an important approach. And yeah, the ongoing engagement, just talking to the other team members involved in the study to make sure everybody's on the same page as to where the project is and any changes that are happening to the project. Then in terms of building a model in the yellow block at the bottom right, the modeling approach is you need to have dynamic inputs and keep an audit trail of those inputs. And what I mean dynamic, you type in a number and the model effectively then recalculates according to that number. That might be anything from a timeline to a CapEx number, OpEx, tax rate, interest rate, whatever it is. You need to have clear input assumptions separated from the calculations. This is really in order to just make sure that the model can be followed. These models do get to be quite large, with quite a large number of sheets. So it needs to be organized in such a way that you can actually work through the inputs easily. Then clear outputs and results sheets, preferably all the key items on a summary sheet where you can see a snapshot of the project, plus then 3 financial statements. So you need a statement of profit and loss, with cash flow waterfall and the balance sheet, in order to make sure that you've actually got everything that you need out of the financial model. Key functionality, yeah, so model timing. So we model the project monthly during the construction phase. This is basically in order to make sure that we can correctly calculate the interest during construction on the debt drawdowns, and also making sure that the IRRs similarly are calculated correctly according to when the equity is drawn down. Quite often what we see these days in terms of the funding is that debt is drawn first and equity is drawn last. So this makes, if you've got a significant wind project with a 24 to 30 month construction phase, this makes quite a significant difference to the results. Then the operation during the operating phase, the periodicity often depends on the debt repayments. It's a financial model, and really it's focusing on the repayments to lenders. So quite often that would be quarterly or semi-annual debt repayments, and that would be, and then the modeled periods would be aligned to that. In terms of the tariff structure, so obviously a lot of the renewable energy projects, it's variable generation based on a take or pay PPA, which use quite a simple variable energy charge per megawatt hour delivered. But a number of projects will have a fixed capacity charge. And obviously the structuring of that is usually based around trying to make sure that that fixed capacity charge will cover the project's costs and returns, even if the project is not dispatched. So those are for dispatchable generation technologies, and then calculating exactly where that fixed capacity charge needs to sit is a part of the model's functionality. And then there's also pass-through costs which need to be considered, such as if you have a lithium-ion battery, it needs to be charged, things like that. Moving on downwards then, funding structures. So we do see quite complex debt structures in these models. Quite often there's 8 different debt facilities considered within them, and these things all play a different role. In terms of equity, there's share capital, shareholder loan, pref shares, and particularly when you breach certain debt ratios, the dividends need to be locked up in the model to correctly demonstrate what would be happening to the project and the equity cash flows under those circumstances. A lot of these models also include community participation, which certainly started with REIPPPP, but we see it a lot on the private procurement side as well, and making sure that the cash flows to the community, if it was on a funded basis, actually are sufficient to repay the funding. So that is sort of like almost a second mini model bolted onto the main model. In terms of construction phase drawdowns, what we see and what we need in terms of the financial modelling is obviously the EPC and construction costs. These need to be split out according to the differences between the line items. So a single EPC or construction cost is fine at concept level or what have you, but at bankable feasibility level, it tends to be split out into sort of 15 to 20 different line items so that each line item can be treated appropriately. And we'll get into some of that. Things like success fees, I mean, the timing of those is then different. Some of it might be paid upfront, some of it might be at COD, etc. Operating costs during construction, insurance, such as insurances, all need to be brought in. Timing of the cash flows is quite key. So each line item within the construction phase, a portion of the model needs to have its own drawdown profile or its own expenditure profile. And again, for instance, you pay insurance in advance, you don't pay it on a monthly basis, as an example. That's the sort of level of detail which is required at the bankable stage, or particularly for financial close. Is splitting the underlying currency of each cost so that foreign exchange sensitivities can be modeled correctly. And then each line item potentially depreciates at different speed and has different tax advantages in depreciation. So we need to split that up quite accurately. Then owner's costs, owner's contingencies. So within the technical work and the costing, there's always contingencies are put in place. So that's that's quite normal. Owner's contingencies are a slightly different thing, and it tends to be the non-EPC type contingencies that need to be put in there. So an owner's contingency might be something like an allowance for imported equipment being stuck at the port. Now the EPC is not going to take the risk on that. And there will be a mobilized EPC unable to achieve anything. So the owners need to effectively put aside additional contingencies beyond the design contingencies to cater for that kind of cost, particularly in other jurisdictions. Sort of delays at border crossings does become a significant issue. Each line item potentially attracts VAT or doesn't, depending on how that's treated. And then also looking at things like cost escalation. So if this is a more of an early stage model and you're forecasting that financial close might be in 2025, not in 2023, then you'd want to be looking at how the costs would be escalating between now and then. Next key functionality then is energy generation. So this actually varies quite a lot. So it depends on what the model is being used for. I mean, in a REIPPPP bid, all that's required is each month, how much is the total megawatt hours delivered? Really quite simple. In terms of the carbon neutrality modeling, we use an hourly generation profile. So, 8,760 hours in a year, in order that we can correctly model the carbon impact as opposed to merely the financial impact. So wind and solar are typically pretty straightforward in this. Other technologies can be a little bit more complicated, depending on whether it's dispatchable and what have you. But I think the key thing here is good financial models tend not to want to reproduce the technical modeling. It's inevitably going to be wrong, and there's perfectly good systems, sort of PV-Syst, etc., which can provide the outputs which are required for the financial modeling. And we do see that there's, it's important to have a lot of interaction between the technical and financial teams in order to get this right. We don't, particularly when, for instance, maybe on a P90 on carbon neutrality, it may not simply be a case of flexing up and down the generation in any given hour. It might actually slightly change the pattern of generation because of sort of, cut-off speeds for wind, where at a certain point it isn't turning the turbines at all. Then moving to operating expenses. So yeah, I mean, there's obvious things: operations and maintenance costs, asset management, etc. Contingencies, again, owners' contingencies being brought into operating expenses, decommissioning costs, whatever other running costs are required. And there's a number of sort of non-O&M related costs that we typically see brought in to the modelling. So, for a solar plant, at night it still has electricity requirements, so it needs to purchase that electricity, even if PV-Syst says that it's a negative negative generation during those hours. And it's all these ongoing costs, which are not necessarily sort of very commercial or very technical in nature, much more commercial. These need to be brought in, and the financial modelling team need to be sourcing those from the appropriate places. Hopefully there's somebody within the feasibility team who can provide those, likes of insurance costs. Then tax. Tax is a big impact in these models. So the way that accelerated depreciation using Section 12B and some of the other sections of the Income Tax Act in South Africa, at least, does have quite a big implication on the cash flows of the project, particularly in the early years. And the changing tax rules, so Section 12B is being temporarily amended to have 125% tax deductibility of the assets if the project is brought into first use before, I think it's about June 2024. These things have quite a big impact, and it's really important to get it right, because if, for instance, you go to, or it's a project in Botswana, the tax rules are very different there. And the typical taxes that we look at then are corporate income tax, dividend withholding tax, interest withholding tax, which is for some jurisdictions, not for others. Those are the, sort of the main ones. But what also needs to be brought in is things like customs duties and clearance fees and things like that as well. Whatever taxation needs to come in to the modelling. So typical key outputs of a model. After all of these inputs have been inserted, calculated, we typically look at project ungeared IRR. You're looking at the sort of top left there. A project, so the ungeared IRR is really just it's the construction cost of the project versus the revenues, the OPEX, maintenance costs and tax. So it doesn't consider the funder's cash flows, but it just doesn't even think about funding at all. The project geared IRR is really looking at the cash invested by shareholders versus the cash available for distribution. So not considering withholding taxes on the cash flows to investors. And then equity, which is really the cash invested by the shareholders compared to the cash that they actually get back, which may be on a pre or post-tax basis. And the differences there are often quite small, but what we do see is some of the accounting constraints might cause trapped cash in a project where it can't release dividends, and so it does have an impact on the actual equity cash flows. Same thing for NPVs, but obviously NPVs are a quantum at a particular discount rate, as opposed to a rate, which is the IRR. And then the other one, payback, typically looking at, again, the three sort of approaches. And again, we look at these normally in both nominal terms and real terms. So nominal terms is the way that most of these models calculate, and that considers, inflation, etc., over time, and is actually focused on saying, in any given year, what will be the amount of cash that changes hands between different parties, whereas real is a conversion back from nominal to strip out the inflationary effect and say what's the number in today's terms. Then the other outputs, obviously financial statements, so the cash flow waterfall, which I suppose the primary rationale for that is calculation of ratios, and the cash available for dividends. Income statement, which is largely based around calculation of tax and what dividends are allowed to be distributed, and then the balance sheet, making sure you understand the value of the assets and liabilities, particularly with renewable energy projects. From that, we calculate any early termination liabilities for the off-takers. So that becomes quite an important aspect of the outputs. Another key output is the sources and uses of funds. This is just an example from actually a fairly simple project, but just to give you some illustration of the type of line items you'll see. This is calculating things like the interest during construction, all the fees that are attached to the debt, etc. Any taxation on those, in order to really tell us how much money does the project need to raise, and how do you do this? I mean, do you include the VAT within that? Do you have a separate debt facility to cover VAT, etc.? And this is, you can see on the left there, the uses. We try to summarize the sort of more capital expenditure items, and then split out the detail of the items which are more key to have the detail on for lenders. And sources, sort of more to the top right, looking at where does the money come from, so how are you funding the project? There's equity, shareholder loans, different debt facilities available, and potentially sometimes you might consider using early operating revenue to fund the project. Depending on the project, that may or may not be possible, but certainly it is an option, normally viewed as an equity risk by the funders, though, who would be less keen necessarily to base the funding or to rely on that kind of revenues to fund the project. Then sensitivities, so inputs to and calculations of the financial model will have to be structured to allow for these sensitivities to be run. And the typical sensitivities we look at is CapEx and OpEx changes, fairly straightforward, nothing too complex there. Any fuel costs in a project or availability of fuel, we touched on before, it is key. The model has to react correctly to that sort of issue. I mean, we've seen, for instance, natural gas projects where the gas supply agreement actually did not cover the full requirement of the project, and how do you restructure the project based on that? So revenue, and quite often this is about the competitiveness of the project. You know, what happens if you reduce the tariff? How does that affect the cash flows and the coverage ratios, etc., while still trying to make a project as competitive as possible if it's being submitted into a bidding process? Then Forex, we've touched on that. Interest rates, again, this is very much a lender sensitivity, but I mean, the debt facilities, I mean, for REIPP, we pay over 19 years. You know, looking at how the interest rates change over time is quite key. Tariff indexation and the movements in CPI and what impact does that have needs to be modeled correctly. And there's obviously a relationship between CPI and interest rates that needs to be considered. Then cost escalations, generation, you know, P50, P75, P90 basis, and sometimes looking at availability as well. Again, what happens if there's an interruption to the availability? A connection line is unavailable for a 2-week period or a 3-week period, and then also construction delays. An example of the sensitivities then, this is a typical two-way sensitivity table looking at movements in CapEx and movements in the tariff. So tariff in the is on the left there and CapEx going across the top. In the middle of the blue cross is your base case, and all the percentages are the IRRs as we flex the two different elements at the same time across different percentages. So typically, you know, if at the bottom left, if the CapEx is much higher, 30% higher, and the tariff is 30% lower, we've got an IRR of 0. At the top left, if the CapEx is 30% higher, but the tariff is 30% higher, we've got an IRR of 19.58%, etc. So that's the typical sort of outputs. We run multiple ones of these to cover all the different sensitivities. Then scenarios. So yeah, I don't know, nothing surprising here, but so scenarios are typically used to assess the alternative technical options to, you know, what's the financial result under different wind turbine suppliers, different PV options. So, yeah, things like fixed tilt versus single axis tracking. Run complex sensitivities there. You know, multiple flexes at the same time. But also to assess different funding structures and different commercial options instead of the way, potentially in the way that the tariff works. So often run, you know, scenarios for different partial indexation type approaches, that sort of thing. And then obviously, once you have a scenario set up, you can run sensitivities against that scenario if required. So that was our sort of base, that's our sort of the core models. Then we sort of start looking into the different types of models which are also used to get these projects through their lifespan. And the first one being an operational monitoring model. So this is the model which typically needs to start being developed for the first day of construction. These models are used to effectively capture the historic actuals of the project, monitor what's been happening on the project, and effectively assist with reforecasting what are going to be the cash flows of the project based on reality so far. These are used for the reporting packs to lenders. So the lenders require reporting packs with each drawdown and then with each repayment of the loans. And the models need to align to the project's management accounts, which has quite a different requirement in terms of functionality to the bid or financial close models. So these models, you know, trying to align a much more detailed basis on what's going on in the management accounts. Adding a bit more complexity to these types of models, you can actually do some quite cool stuff in terms of sort of the actual versus budget variance analysis. So what was the expectation at financial close for different cost items and how are they changing? And you can potentially also do quite a lot of quite complex reforecasting of future cash flows based on actuals to date, in order to run various sensitivities again on a looking forwards basis. And again, another one, which is quite a common one, is the impact of restructuring. So if you were to refinance the debt, what would be possible? And this is typically once a project's been operational for some time and it's proven, you can either you can refinance in order to gear the project higher again, and the equity shareholders take that as effectively a lump sum cash payment, or just to get cheaper debt into the project. Then moving on, we've got multiple models to develop and implement a renewable energy strategy. So when it comes to a strategy, it's a process to get there. So this is just a little sort of flow chart to try and illustrate what happens. And starting on the left there, sort of pre-feas or concept stage, just trying to sort of get almost a benchmark type approach and have some feel for where the answers might end up. And this, when we're talking about a strategy, talking about an energy consumers strategy, and starting to look at, you know, either single site or multiple sites at a sort of pre-feasibility level, getting a feel for what the implications are there, moving through to an RFP procurement process, assuming an IPP approach is selected. We then look at a different model for saying, well, which of these IPPs is the most suitable? You know, which one gives us the best answer? And then again, into bankability, there's going to be the BFS model we've discussed, which may or may not be owned by the off-taker. It may be with an IPP, that model may be owned by the IPP instead. But the off-taker may have detailed modeling requirements. They want to understand the ongoing implications as an off-taker, as opposed to an equity or debt funder of the project. I think from a timing perspective, might just need to skip this slide. This is really just recapping on what these models do. You can do that you know, from the recording. I think one of the key things to talk about here, which is becoming much more commonplace, is the carbon neutrality modeling. So having a generator with an off-taker in the same financial model and understanding the implications of these types of models. I suppose the first thing is the tools that are used. So we still find project finance models are still best built in Excel. It's easy for anybody to understand and follow. It's well understood. You can share the model. You can share the functioning model, not just outputs. And it's relatively flexible and quick to adapt to new requirements as the project changes. You know, if you need to build in a new type of preference share facility, it can typically be done in, you know, the space of a day or so, maybe a few days, depending on the complexity, but relatively quick. In terms of the carbon neutrality modeling, though, of complex energy strategies, we do find that financial models aren't necessarily the best for that. So we work quite a lot with Zutari using the Plexos software. I know some technical firms use Homer. I think there's a number of others. And this is looking to actually develop, what do you want to build? So what generation assets are going to be required in order to achieve the carbon neutrality objectives of the off-taker? And that's something which these types of software are designed for and very good for that. Financial models that we use typically are not really well designed to achieve that kind of answer. The models obviously need to consider grid constraints, things like that, in order to make sure that you know, so that the answer is true. But what those softwares tend to do is they tend to work on an LCOE type of approach. So they can, and on that basis, can give quite good comparative results. But it doesn't necessarily result in the absolute financial result for the off-taker. So that's where the financial models typically come in then, which is to say, well, what is sort of designed in Plexos or Homer, and pull that into a financial model to give you an actual financial result using tariffs instead of sort of LCOEs, etc. So off-taker modeling, the key objectives is really looking at, for the off-taker, what is their level of carbon neutrality or the renewable energy penetration, and what cost savings would they get from having this renewable energy project. What's typically involved here is we take our bankable project finance model and we bolt on an off-taker module to it. We use hourly or occasionally half-hourly load forecasts and generation forecasts with a 20-odd year horizon to those. And again, detailed modeling of the grid electricity tariff structures that the off-taker is currently paying, which have some complexity in the time of use type structures that you'll get with the likes of a Eskom Megaflex. So these things are, while the funding, etc., the capex and the construction phase remains the same, there's quite a lot more detail in the energy aspects here, so that we can calculate a carbon neutrality on an hourly basis and the displacement of the grid tariffs on an hourly basis. And simplistically, the way that these models work is you have a do nothing base case. So what happens when, if you didn't build a project, how much would you be paying to the likes of Eskom? Then you have a with renewables case. So, you have the renewable energy penetration based on the hourly generation and loads, and the renewable energy tariffs for the energy that's consumed, as well as any liability for excess or curtailed energy. And simplistically, these models are then calculating the savings based on the difference between the do nothing and the renewables case. You then obviously need to pull in a tax implication on the off-taker, because now their operating expenses have changed, as well as model the accounting impacts. So what happens in terms of contingent liabilities, early termination, etc. Is there any implication due to an accounting consolidation, as well as then sort of scenarios such as if you can sell excess energy to the grid, Eskom's standard offer, or potentially secondary third-party off-takers. What we tend to find with these models is actually one of the biggest sensitivity is the grid tariff escalation rates. I'm pretty certain everybody is well aware that it's quite difficult at the moment to predict what Eskom's next escalation will be. Very often the same with some of the other jurisdictions in sub-Saharan Africa as well. And yeah, so that normally comes out at the top of the tornado graphs of sensitivities, because it's potentially one of the bigger movers and has the biggest impact in terms of the financial savings that are achieved through the project. When we're doing modeling the do nothing base case, just to give a feel for what we're talking about here, looking at Eskom Megaflex, on the right we have a little graph of the time of the day, and then the first column is Mondays to Fridays, green being the off-peak, red being peak, and yellow being standard. And you can see how the tariff structure changes between the different weekdays. Then we also have a different structure for the low demand season. So the model needs to follow all of that correctly. It needs to obviously place the load profile correctly over time. Is the load growing? Is it changing in terms of its shape over the course of the years, in different years? Things like is there an annual shutdown in December? I mean, is there a 2 to 3 week period where the load is dramatically reduced. That sort of thing is really important, as opposed to having merely an average for the year. Another one which is quite interesting to include is a forecast carbon tax. While Eskom is currently exempt from carbon tax, the mechanics are already in place legally and commercially. But if Eskom loses its exemption, even on a sliding scale, carbon tax will form part of a Megaflex invoice. So understanding, potentially the impact of that on the project is quite important. And then also structural tariff changes to Megaflex. So things like the generation capacity charge, where we have a portion of the variable tariff being converted to fixed, has a significant impact on the potential financial savings that can be achieved, because a solar project or a wind project, whatever, can only make a saving against the variable portion of the tariff, not a fixed monthly charge that needs to be paid to Eskom, irrespective of the energy consumption. Again, modeling with with renewables. So yeah, again, very similar sort of IPP module is solved for with a tariff, and we simply match the generation against the hourly load. Need to consider the remaining demand from the grid and associated carbon tax. What is the cost of the renewable energy, particularly under different tariff structures? So if you do have a fixed capacity charge, that's got to be brought in quite clearly. Cost of wheeling, if that's applicable, and obviously the cost of the excess or curtailed energy. These are some graphs just illustrating some of the differences between, in terms of the time of use tariffs and the impact on solar projects, the two graphs on the left, and wind projects, the two graphs on the right. So these are showing the generation profile across a day, and you can just see the red boxes are highlighting really the Eskom peak periods. And you can see, as an example, the wind projects on the right are picking up the early, or are picking up the later peak periods of within their generation profile, whereas the solar projects are only picking up the earlier peak tariff periods. That's the peak periods being the red parts of those graphs. So that's just meant to illustrate more or less, sort of how we can see these different types of projects having different impacts on the off-takers. Again, this is some of the changes which are likely to be happening to the Megaflex tariff. We've touched on the generation capacity charge, but there's potential changes to the time of use tariff structure, as well as various sort of rebalancings in terms of the difference or the differential between standard rates and off-peak rates, and all of this needs to be brought in so you can understand within the financial modelling what some of these changes might mean to the financial impact of the project. Then moving on to wheeling modelling. So wheeling is the use of the national grid in order to transmit energy from a generator in one location to a load in another location. This is really just an accounting reconciliation at the moment by Eskom, and it's done based on the time of use period. So if you generate during off-peak, it displaces consumption during off-peak. And that doesn't matter whether the generation is early in the morning on a Monday or at midday on a Sunday. Those are both off-peak, and that's the way that reconciliation is done. It is possible to have multiple loads for one generator. There is a cost to the wheeling, and it's quite important to model that correctly. It varies depending on the voltage of the connection, it depends on the location, etc. And currently the largest part of it is in subsidies, so rural electrification subsidy, etc., is actually the biggest cost component of the total cost of wheeling. Which is different to the way that Eskom tends to define the cost of wheeling, which is a bit more sort of technically specific. I think the key thing here as a takeaway is that that wheeling reconciliation is different to the carbon neutrality calculation. So if the carbon neutrality is done hourly, that is not the way that wheeling should be currently modeled. We don't know quite where that's going in the future. So sometimes we do switch our modeling to look at it on that basis. But the impact of renewable energy, because of the way that it's done on a time of use basis, is better on a wheeling basis than a carbon neutrality basis, simply because you can reconcile potentially more of the energy, as opposed to on the carbon neutrality basis, we can't use all the energy in a given hour. You don't get to move that to a different hour. Cogen models, so this is looking at things like sugar mills, paper mills, etc. These are typically very, very bespoke models, often with an SPV structure still, but not necessarily. CapEx is typically high pressure boilers, and you need to calculate things like the value of steam or process heat that goes between the host plant and the co-generator. Often, again, working out what's a fair value for the feedstock. If you think in sugar, bagasse is one of the main feedstocks. At the moment, it's a waste product. Now it becomes a fuel, or it becomes a commercially valuable fuel, and what's it actually worth? Is there some sort of level of payment which should be made or revalued in terms of the way that you look at the sugarcane? But also any additional costs involved. So if certain parts of the country sugar has a different harvesting method, if you need to increase the amount of bagasse that needs to be collected, and what sort of impact does that have? And again, these types of projects are dispatchable power mid-merit, running typically for maybe 8 months of the year, or paper mills more months. So that involves fixed capacity charges, and also quite specific sensitivities for those kinds of projects. Battery energy storage. This is something that's become quite popular in the last sort of 5 years or so. Very much more so in the last couple within the Southern African context. So we see that, and if we use lithium ion as an example here, we see that it's quite different in terms of the way that you use these assets. So you first of all have, in terms of financial modeling, you need to understand what the use cases are. Is it carbon neutrality? In receiving renewable energy from a generator and trying to effectively using it to change the demand of the generation profile to improve the renewable energy penetration? Is it for energy security, so avoiding load shedding or load curtailment? And then the key thing there is understanding what does that benefit actually give you? What's the avoided cost of lost production? Because that's effectively then the revenue line for the project, and that can be quite a complex element to understand, depending on what the host plant is. Then we also bring into this type of financial modeling sort of value stacking options, and seeing what you can potentially do. So tariff arbitrage is a key one. So trying to displace peak time of use tariff periods by effectively charging them during off-peak or with renewables, and you trying to work the battery to a commercial benefit using that, which, depending on where your belief in the capex is, it may or may not work. Another one is looking at if a host plant has starting loads which are significantly higher than the running loads, you can potentially use lithium ion to prevent having to have a higher notified maximum demand. The NMD is effectively the fixed monthly charges, and is sized to be generally a bit larger than the highest starting loads. So that can be quite a significant saving because you know it's a fixed monthly charge that can be potentially dramatically reduced with BESS being involved. Ancillary services to the grid, so in terms of reserves, and then potentially also in the future selling energy into the grid. I think the key thing about this is that the use case is not a single use case. In terms of the modeling, you may well be having multiple use cases for an asset. It may be that you have different use cases during the winter months. You might find the BESS being used for tariff arbitrage more, or selling energy into the grid, whereas maybe during summer months or something, it might maybe more energy security or carbon neutrality, or trying to achieve some blend of this in order to get the objectives for the client. So these models are quite complex in terms of trying to target multiple different aspects. In terms of the methodology, so we stick to the SPV approach usually. We need to consider the megawatts power in terms of the maximum rate of charge and discharge, and the megawatt hours of storage capacity, including degradation. And we model these things hourly in order to get this right. And we basically put together an event calendar to say, well, what is the BESS actually being used for? I mean, how is it being charged and discharged to achieve the objectives for each day? And how does that change over time? So this is quite a complex sort of setting up process in the financial modeling in order to really understand how the BESS will be cycled. And part of that is obviously considering round trip efficiency, degradation, and what's the total cycle. So we find with these types of projects, I mean, the lifespan of the asset will vary depending on the utilization approach, and also depending on the way that a view is taken to with degradation. Do you have periodic enhancements to the capacity, or do you sort of accept at that degradation and potentially reducing level of energy penetration? Another one which we consider is, in terms of the charge rate, do you limit it to the notified maximum demand, or rather the difference between the host plant load and the notified maximum demand, or do we model to exceed the NMD and accept the penalty cost of doing that? And which of these gives you a better result? Because potentially there isn't much time to recharge the BESS between different discharges. Obviously, the key thing is to calculate the savings to the off-taker, and quite an iterative scenario process is used to achieve the optimal result. Bid scoring models are really quite simple in the sense of the bidders need to provide a tariff indexation, and an hourly generation profile. We can plug these using the same macroeconomic assumptions. We can plug these into a model which then calculates which of these provides the best NPV of savings for the off-taker. So it's not all about tariff. The hourly generation profile and the indexation does make quite a difference. And it's quite important to get that holistic view of how do these three things interact, particularly if there's some sort of variation in loads or in terms of the view of where Eskom is going. Energy strategy. So this is really just a really complex version of the sort of generator off-taker model. It just has multiple off-takers, multiple generators, still modeling each project individually, each load individually, looking at sort of the commercial allocation of energy and the commercial pricing of energy between off-takers and the prioritizations there. Also considering potentially the electrification of diesel equipment at mining sites. You're not saving against Eskom, you're saving against the cost of diesel. And you could consider within that CapEx and other implications at a fairly high level still, but to try and get a broader energy strategy together. And what we see from these models is that generation project diversity, particularly multiple wind farms in different locations, helps create almost a sort of quasi baseload generation effect, which avoids having to have too much curtailed or excess energy. And within this, also typically looking at ownership implications and structure. Then finally, I'm just trying to finish with enough time to take some questions. Is the decarbonisation financial models, which at the moment we see the focus is on scope 1 and scope 2 emissions. So that's the on-site emissions you generate yourself and the emissions you effectively generate by buying energy from a utility. So we do, within these models, we do consider non-electrical energy consumption, so LPG that might be used to fuel a furnace or whatever. And these models also entail different types of projects. So electrical energy is an important part of them. We can pull into this type of model energy efficiency projects. So that impact on emissions, the electrical load, OPEX requirements, etc. We look at various forms of projects to reduce emissions. So if you were to plant a forest as a carbon offset project and consider that within the total emissions, various procurement options and commercial structures also can be included within these types of models. And the key outputs, again, NPV of savings and sort of annual cash flow impacts. Then we also look at emissions on a similar basis, so NPV and annual reductions in order to try and get to a sort of a scenario comparison position. Overall achievement of carbon neutrality. Now these models potentially can include scope 3 emissions, but yeah, it's been limited focus on that. I think everyone's still feeling their way through these things and focusing much more on scope 1 and 2. That brings it to an end. Very happy to take any questions. Richard or Minx. Richard, I believe you've been collecting any questions that, and will let me know what burning issues I haven't addressed.
Thanks, Andy. And yeah, that was quite comprehensive. I did manage to follow you for 90% of the time, so I'm quite proud of myself. And I must say I have experienced quite a lot of these different models. I mean, we're doing a lot of cogen at the moment, and it becomes quite complex. Just out of curiosity, do you do any sort of Monte Carlo and probabilistic assessments? So, for example, if you take the sugar industry, you have different years. Rainfall affects the calorific values, affects the steam production, affects the gas. And another issue on probabilistic studies is I saw a presentation by Eskom the other day where they indicated that I think the actual wind energy was approximately 50 or 60% of what had been forecasted was actually what's being pumped into the grid from wind. I just want to see if you've got any thoughts on those two aspects of it, the whole probabilistic aspect.
Yeah, so for our mining clients, not renewable energy, but simply when we're doing modeling for mines, we do quite a lot of Monte Carlo analysis. It's pretty standard in that field. We tend to find that the lenders or the project financiers tend not to go for Monte Carlos with renewable energy. What they prefer is defined scenarios. So I think the bagasse one with lower rainfall and a different calorific value in the bagasse is a really good one. But from the funder's perspective, it tends to be they will want to pick a scenario which can be written out and defined, get the technical implications of that and put it into a financial model and understand what that means in the financial model. So we don't tend to find that most of our projects have Monte Carlos. I mean, the typical wind or solar projects, it's very much a case of, the equity view is a P50, the lender's view might be a P75 or a P90, and we're normally asked to flex the generation down oh, sorry, yes, I'll share my webcam, is to normally flex the generation down to see how much less generation is required in order to breach certain ratios in the cash flows. So they have a slightly different view of the world. But certainly, yeah, I mean, Monte Carlo can be done. It tends not to be a funder's requirement as much in my experience.
Okay. Just a second question from me is, have you ever done any modeling for complete off-grid? So people that are looking to take significant loading off the grid. And have you got, and are you prepared to share what the sort of break-even numbers are on that, if you can reach them?
I don't have any to hand, I have to admit. We have done that kind of model. In fact, we've done that with Zatari, I think. But it does depend. I mean, what we've seen is typically this is off-grid mines in other jurisdictions, and it's quite often a case they currently have HFO gensets or diesel gensets, and they're really trying to use various renewable energy assets as almost as a sort of widget to reduce the fuel consumption. And what we tend to find is for those types of operations, they tend not to be prepared to give up on their gensets, even if you can, in theory, get full renewable penetration. They tend not to want to get rid of the thermal assets, and I think that's, you know, in terms of if something goes wrong, the value of lost production at a major mine is really dramatic. You know, so they tend to bring in the renewable energy, aim for a high level of penetration, but not to island on a renewable basis.
And have you done any modeling for municipalities at all in terms of, I know we hear about this municipal death spiral. I mean, a lot of your stuff is private sector at the moment, but have you had any public sector engagements? I think you've got the tools and the experience to offer significant value in the public space. I'm just curious to know if anyone's ever come to you about that.
We've worked quite a lot. Well, we've responded to tenders. We've worked quite a lot in terms of municipal wheeling. So working with the municipalities, obviously Nelson Mandela Bay is sort of most advanced in this respect, but sort of Cape Town and others have got sort of certain frameworks in place. And so we've worked a lot with the municipalities about wheeling using municipal grids, because there's a certain level of complexity in terms of if you have a generator that's connected to ESCOM and a load that's connected to a municipality, the way that the cost structures are put in place. We've done quite a lot of that, but not really any working directly for municipalities, which is probably, I suppose, goes to show that we don't put our tender responses together well enough. I don't know, but yeah, I think there is definitely some scope in terms of the municipal death spiral. But it may well be that some of that is a bit more sort of economic focused as opposed to financially focused. You know, bringing in sort of development economist type role.
Yeah, yeah. Now I see some of these energy policies come out, and the guys don't seem to have excessive understanding of the complexities sometimes behind the financial modeling.
Yeah, I mean,
okay.
Just to add, what we have seen, for instance, in Nelson Mandela Bay is a clear understanding that they shouldn't be making money from energy as such, but rather making money from the grid infrastructure, because that way, you know, because the energy cross subsidizes other municipal services, you know, so water, waste collection, etc. Certain municipalities have built their tariff structuring correctly in order that, you know, allowing wheeling doesn't have a negative impact on their cash flows. I think others are still working towards that.
Yes. I mean, one of my frustrations with the Eskom wheeling is that it doesn't follow logic, whereby you're importing, you're say inserting power in Pretoria or Gauteng, and you're buying it, wheeling it down to KZN. Obviously, the electrons don't flow that way, but they'll charge you the full 7% transmission zone additional tariff structure, which is I mean, a fatally flawed way of thinking. It'd be nice once Eskom moves on to something that makes sense in that regard.
It certainly would. I suppose historically, I mean, when wheeling started, when was it, 2008, 2009, there were so few wheeling deals, it probably didn't matter.
Yes, but it's a big cost.
It is, but yeah, it's certainly with much more private generation looking to wheel, it is something that needs to be re-looked at.
I know it's a barrier. I mean, it's my frustration because it's a barrier, and we're so short of power, and you've got these sort of hidden, like they put the renewable energy charges supplementary on, and before you know it, you're paying 20% of your energy cost on wheeling. It's just, it's not, it's actually a barrier to embedded generation in a time of crisis. But anyway,
yes.
there are a couple of questions here. Raholo Malaysi, hi Andy, do you see substantial benefit for modeling hourly time steps versus a categorized time slice based on the characteristics of the load generation and grid tariff?
We do, yes. So at a sort of pre-feasibility level, we might consolidate the hourly profiles into, you know, add up all of the 1 o'clock in the mornings in January, all of the 3 o'clock in the mornings in March, etc., to simplify the model. And when you do a comparison between the energy penetration with that approach as opposed to a pure hourly profile, the consolidated approach has this averaging effect. And on a sort of one-to-one, let's say if you take a solar generator to a single off-taker, and it's a well-sized solar project, so it's potentially slightly oversized in order to get the best penetration into the peak energy periods, you'll find that the averaging effect will, in essence, tell you that you're probably about you're going to have 8% less curtailed energy than the pure hourly modeling would. So depending on the level of detail and where the project is, it does make a big difference. On the other hand, what we do find is that as soon as you bring in multiple generators and multiple loads, that has an inherent averaging effect anyway, and it significantly reduces the inaccuracies caused by that approach. So it depends on what you're modeling.
Okay, we went on the swings and you use on the roundabout. Okay, just a point here. Someone asked if the slides were available. They're actually available in the handout section. There is a copy of this presentation. You can take it. Also, there is a SAIEE Academy training brochure and an issue of the What's On magazine. So help yourselves to all those downloadables. And just a couple of thanks in the questions and honors questions section. I don't see any further questions, Andy, at all. Let's just have a look. But I want to just thank you for your time. I take, it's very, I mean, I'm dealing with this quite a bit at the moment. So I'm seeing a lot of value in your presentation. Thank you very much. I do appreciate it.
Pleasure.
And I hope most of our members can too.
Yeah, pleasure. Thanks, everybody. Thanks for taking the time, and I hope it was valuable for everybody. And feel free to get in touch if they've got any further questions later on.
Perfect. Thank you. And to everyone, have a great evening. To those in KZN, be safe in the rain. From the SAIEE KZN, thank you for attending this. Farewell.
Thanks, everybody. Keep well.